Welcome back, everyone. This is a brief update on the oil market. Traditionally, in January, many financial forecast reports are released for the year ahead. And if we are speaking on oil output and demand, the market sparks great interest. Even though forecasts are just numbers which are based on various facts and previous performance, reality most of the time is much more difficult to predict. And so we maintain some uncertainty as to the reliability of these expectations. During the previous days, the U.S. Energy Information Administration stepped in to increase its 2019 global oil demand estimate by 20,000 barrels per day in comparison to its prior estimate. The report goes on stating U.S. WTI production could rise to surpass 12 million barrels per day in 2019 and to climb even higher to 13 million barrels per day in 2020. On other news, Japanese oil purchasers are expected to restart business with Iran. Back in November 2018, Japan stated it would make use of exemptions provided by the US to keep imports from the Middle Eastern nation. According to Japanese Trade Minister, it's up to private companies to maintain their oil trading with Iran. Iran plans to counter US sanctions with private company oil trading. And this is a strategy that could be used even more in 2019 by the Persians. We must note here that during the previous week, the U.S. State Representative regarding Iran announced that the U.S. will not be giving further exemptions to countries associated with Iranian oil trade. On the OPEC front, the Saudi Arabian energy minister said oil demand continues to be solid and that further action could be taken if demand levels are changed. He also stated that there was no influence observed from the U.S.-China trade conflict. Very clearly, the OPEC Plus group is taking action in order to offset rising American output. This plan targets to bring global supplies to balanced averages and increase confidence, while eventually setting the precious commodity price into a more bullish territory. On the other hand, the US shale oil producers may be having the exact opposite scenario in mind as per supply. The US oil production has the potential of pumping huge oil gluts, as they could be satisfied with lower prices range to 55 to 60 US dollars per barrel, as opposed to 70 to 80 US dollars per barrel OPEC is comfortable with. From a purchaser's perspective, we see the Asian market as ever growing for oil demand and the most dominant. As a conclusion, the EIA expects the oil prices will remain lower than during most of 2018, where the average was $65 per barrel. This opinion we also share, as the competition between OPEC Plus and the US could continue for the next years. For more information and trading ideas, you can visit our webpage. Follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+. This is Angelo Zittis from IronFX, wishing you solid trading.